A war in the Middle East is sending shockwaves through global financial markets. Oil prices are surging, stock markets are falling, shipping routes are suddenly under threat, and investors around the world are asking a very serious question. How big could this economic shock become? Because when conflict erupts in the Middle East, the entire global economy starts paying attention. And right now the Iran war is unfolding in one of the most strategically important regions on Earth. To understand why financial markets are reacting so quickly, we need to start with what has just happened. In late February 2026, tensions in the Middle East escalated dramatically when the United States and Israel launched strikes targeting Iranian military and nuclear infrastructure. Iran responded with retaliatory attacks across the region. Energy facilities were targeted, missiles were launched, shipping routes were suddenly threatened, and within days the conflict expanded into a much wider regional crisis. Financial markets reacted almost immediately. Oil prices surged dramatically. At one point, Brent crude jumped above $110 per barrel, marking one of the fastest price spikes in recent years. In fact, oil prices climbed sharply in just a few days as traders feared major disruptions to global energy supplies. That kind of move doesn't happen often, but the reason markets reacted so quickly comes down to geography. Because Iran sits right next to one of the most important choke points in the global economy, the Strait of Hormuz. This narrow stretch of water connects the Persian Gulf to the rest of the world, and roughly 1/5 of the world's oil supply moves through it every single day. That makes it one of the most important trade routes on Earth. If that route becomes disrupted, the consequences ripple across the entire global economy, and that is exactly what markets are now worried about. As the conflict escalated, shipping through the Strait of Hormuz slowed dramatically, some tanker traffic halted entirely, energy producers across the Gulf suddenly struggled to move their oil exports, and global oil supply immediately came under pressure. The result? Oil prices surged, markets started falling, and volatility began rising across global financial markets. Asian stock markets dropped sharply. Major indices across the region slid as investors rushed to reduce risk. European markets followed. Even the normally stable major European indices dropped as investors reacted to the uncertainty. When geopolitical crises erupt, markets tend to react in predictable ways. Risk assets like stocks often fall, safe haven assets gain attention, and commodities, especially oil, can move dramatically. But what makes the Iran war particularly dangerous for financial markets is the economic chain reaction it can trigger, because wars don't just affect geopolitics, they affect energy, and energy affects everything. Here's the chain reaction that investors are worried about. War disrupts energy supply, energy prices rise. Higher energy prices push up inflation. Higher inflation forces central banks to keep interest rates higher, and higher interest rates slow economic growth. That entire chain reaction can start with one thing: oil, and right now oil is at the center of the story. Within days of the conflict escalating, crude prices surged to levels not seen in years. Some analysts warned that if disruptions continue, oil could move dramatically higher, even toward $150 per barrel in extreme scenarios. Why? Because the Middle East remains the heart of global energy production. Countries like Saudi Arabia, the United Arab Emirates, Iraq, and Kuwait export enormous amounts of oil through the Persian Gulf, and much of that supply passes through the Strait of Hormuz. If that route becomes disrupted, the world suddenly loses access to a huge portion of its energy supply. Even the fear of disruption can move markets, because energy markets are extremely sensitive to geopolitical risk. And when supply becomes uncertain, prices rise quickly. But oil isn't the only market reacting. Currencies have started moving. The US dollar strengthened as investors searched for safety. Gold initially surged as traders moved into traditional safe haven assets. Bond markets also reacted as investors tried to anticipate what central banks might do next. And this is where things get particularly interesting. Because the global economy was already facing a delicate situation, inflation had been slowing, central banks were beginning to consider interest rate cuts, markets were starting to price in easier monetary policy, but the Iran war may suddenly complicate that entire picture. If energy prices rise significantly, inflation could start moving higher again, and if inflation rises, central banks may have to keep interest rates higher for longer. That would create a very different economic environment. Higher borrowing costs, slower growth, and potentially weaker stock markets. This is why investors are watching energy markets so closely right now, because oil isn't just another commodity, it is the lifeblood of the global economy, and when oil moves sharply higher, the effects are felt everywhere. Transport becomes more expensive, manufacturing costs rise, food prices increase, and consumers around the world feel the impact. This is why analysts are now discussing 3 possible scenarios for how this conflict could affect global markets. The first scenario is the most optimistic. The conflict stays contained, military strikes remain limited, shipping routes gradually reopen, and energy markets stabilize. In this scenario, oil prices may fall back as fears ease, stock markets recover, and the global economy avoids a major shock. The second scenario is more dangerous. The conflict spreads across the region, energy infrastructure becomes increasingly targeted, and shipping routes remain disrupted, oil prices stay elevated, and global inflation rises again. That scenario would create significant volatility across financial markets. Stocks could struggle, interest rate cuts could be delayed, and economic growth could slow. But there is a third scenario that markets are quietly worried about: a major escalation. If the Strait of Hormuz becomes completely blocked, even temporarily, global energy supply could face one of the largest shocks in modern history. Remember, roughly 1/5 of the world's oil supply moves through that narrow waterway. A disruption on that scale would send oil prices sharply higher. It could trigger inflation spikes across multiple economies, and it could force central banks into extremely difficult policy decisions. Now, that worst case scenario is not the base case right now, but the reason markets react quickly to geopolitical crises is because investors constantly price in risk, and even a small probability of a major disruption can move markets dramatically. So what are investors watching now? There are several key indicators. First, oil prices. If crude continues climbing sharply, it signals markets are increasingly worried about supply disruption. Second, tanker traffic through the Strait of Hormuz. Shipping data provides one of the earliest signals of whether energy supply chains are stabilizing or deteriorating. Third, volatility in financial markets. The VIX index, often called the fear gauge, tends to rise when geopolitical risks increase. Fourth, safe haven assets. Movements in gold, the US dollar, and government bonds often reveal how investors are positioning for uncertainty. And finally, central bank signals. If policymakers begin warning about inflation risks linked to energy prices, markets may start adjusting expectations for interest rates. So what is the big picture? The Iran war is still evolving, and geopolitical conflicts are always unpredictable. But history shows something very important. Wars in energy-producing regions often have consequences far beyond the battlefield. They can reshape financial markets, they can change inflation dynamics, and they can influence economic policy for years. Right now, global markets are still trying to understand how serious this conflict could become. If the situation stabilizes, markets may recover quickly. But if the conflict expands, the economic consequences could grow significantly. And that is why investors everywhere are watching events in the Middle East so closely. Because sometimes the biggest economic shocks start with geopolitical events that few people initially expect. If you found this analysis useful, make sure you like the video, comment your thoughts, and subscribe for more insights into geopolitics, financial markets, and the global economy.